I'm delighted to be here, more so because Mint has been a familiar newspaper for quite some time, a paper which I do read every day for its analytical and incisive articles and reporting. And also very happy to see so many known faces here from the banking sector and from elsewhere. Now, it's indeed a matter of great pleasure for me to be here today in the Annual Banking Conclave of the Mint. I'm told that this is the 13th edition of this conclave, and this has become a prestigious annual event attracting the best and brightest minds of finance and banking industry. I do understand that you had a day-long discussion today, and there are other panel discussions following this, and I'm sure the discussions are proving to be extremely useful. Several issues facing Indian banking sector have occupied the attention of policy makers in the last few years. Being a regulator and supervisor of banks, the Reserve Bank stands committed to ensuring sound and robust banking system in the country. Emergence of new business models and new technology and its application in banking and finance have thrown up new opportunities. With the aim of taking deeper look at India's banking sector in the context of new developments, the topic that I have chosen for my talk today is banking landscape in the 21st century. I have a prepared text of my speech, but what I propose to do is that we will be, after the speech is over, we will be immediately uploading it in the RBI website. So I do propose to just capture the essence of what is here, and also a few points which are not here. I do propose to briefly capture them and sort of summarize and present it before you, after which we can have the discussions or the questions and an answer. The finance and banking have emerged as engines of global growth. It's argued that, and in my opinion, rightly so, that technology has played a pivotal role in proliferation of financial services. Checks, wire transfers, ATMs, credit cards were important innovations of such nature. Fast forward to more recent times, it seems that we are already witnessing yet another paradigm shift in banking on the back of a technological revolution that promises better customer experience, risk management, and return to shareholders. Given this environment, it becomes extremely important to understand what it entails for the banking sector and how we can prepare ourselves for the times ahead. Against this background, I would like to focus mainly on the trends in digital banking, the trends that are emerging in modern banking today, and I mainly would like to focus on banking for the 21st century, and what your theme today, which you have presented, is for a $5 trillion economy that India aspires to become. So if we look at the banking sector that India should have in the 21st century, the banking sector where the banks have a certain role, the regulator and the supervisor, the Reserve Bank has a certain role. So if you're focusing on that as the theme, then I think what is important is to focus on the responsibilities and challenges which lie ahead for the Reserve Bank as the regulator and supervisor of banks, and the banks themselves being very important stakeholders and very important players in this banking sector. Now, so far as the RBI, so I would like to focus on the roles and responsibilities and the challenges which the central bank encounters, and I would then focus on the the responsibilities and challenges which the bank would encounter in achieving this goal of having a modern, robust, and resilient banking system for the 21st century, which will sort of provide the basic platform for a $5 trillion economy to meet the needs of a $5 trillion $5 trillion economy that India aspires to have. Now, so far as the RBI is concerned, as you know, right after the global financial crisis, the focus has been at the international level, the focus was through the aegis of the Basel Committee and the Financial Stability Board. Certain regulatory norms, the Basel III norms, etc., have been brought into operation. And in India, as you would be very well aware, by and large, our regulations are in fact, I should not say by and large, I would like to say that our regulations are in compliance of the Basel III guidelines. And so in this background, I think in the context of the ever-expanding dimensions of banking sector in the 21st century, we need to be aware of the extensive regulatory and supervisory reforms essential for ensuring stability and inclusiveness of our banking sector. It has been RBI's endeavor, as I said earlier, to constantly improve the efficacy of its supervisory and regulatory functions so that the resilience of the regulated financial entities can be enhanced. A number of steps have been taken in the recent past in this regard. In particular, RBI has recognized the supervisory and regulatory we have reorganized the regulatory and supervisory departments of the Reserve Bank with the aim to improve coordination and allocate resources more optimally. From a supervision planning process and cyber incident reporting and ensure seamless collection of data. Thematic studies will be undertaken across banks and other financial sector entities. New elements of supervision will also be introduced from time to time. Now, basically what we propose to do is that across banks, non-banks and other financial sector players, we propose to identify themes which should be taken up for, more detailed thematic studies. And based on the outcome of the thematic studies from time to time, that is, from year to year or from time to time, even within a particular year, the new elements of supervision will be introduced depending on the nature and the quality of the emerging vulnerabilities. We live in an interconnected world. We live in a layered kind of financial structure that we have. We have several tiers of the banks and non-banks. So one has to look at the entire sector holistically. You cannot just, today, when you do supervision, you cannot just focus on one bank which is under your supervision at a particular time. Let us say we have different teams supervising different banks. Now, one team goes and supervises, let us say, one particular bank. But that's not enough. When you are living in an interconnected economy where that particular bank has a lot of interconnected and a lot of interdependence or a lot of interface with other banks, other financial sector players, NBFCs, the core investment companies. So therefore, you need to make your overall supervision much more comprehensive. So therefore, we propose to undertake thematic studies across various financial sector entities, and based on these thematic studies, based on the results and the outcomes that we arrive at, new elements of supervision will be introduced from time to time, and the banks, of course, will be kept informed that we are going to look at these aspects, and in any case, we would be asking for data and other details from from the banks. So the proposed research and policy division and risk specialist division in the RBI will assist this whole process. Now, appropriately recognizing the systemic importance of non-bank finance companies, as I mentioned a little while ago, and their linkage with the financial system, the RBI has also taken necessary steps to ameliorate concerns relating to the asset quality and liquidity of the NBFCs. The amendment to the Reserve Bank India Act, which was brought into force on August 1, has given additional powers to the Reserve Bank of India with regard to regulation of the NBFCs. And as I have mentioned on several occasions in the past, the top 50 NBFCs are being closely monitored, very closely monitored by the RBI. And the next 50, that is from 51st to 100, NBFC, 100th NBFC in terms of size. They're also being monitored by the respective offices of, respective regional offices of the RBI. Now, in addition to the 4 pillars of supervision which we have had so far, namely on-site inspection, off-site surveillance, market intelligence, and reports of statutory auditors. In addition to these 4 pillars of supervision, a 5th pillar of supervision in the form of periodic interaction with all stakeholders, namely statutory auditors, credit rating agencies, credit information companies, mutual funds, and banks having large exposure to NBFCs. This has also been introduced to have a clearer understanding of the emerging risks and developments in the sector so that critical information is available whenever required. Now, apart from that, the banks and the non-banks, we have also improved. We have brought about a lot of changes in our supervision of the cooperative banking segment. We have developed a robust stress testing framework for urban cooperative banks. It also, which acts as an early warning system for cooperative banks with the purpose of timely identification of weak banks and taking appropriate action. In fact, there is a lot of work which we have done in this regard. As you know, that we have now made, the inflow of acrylic data also from the cooperative banking sector mandatory. And to sort of elaborate further, I would like to say that there is also a shift from reactive to proactive supervisory approach intended to ensure surveillance of vulnerabilities in the urban cooperative banks. Moreover, as on 31st December 2019, more than 90% of the urban cooperative banks have become compliant with the CBS. Although efforts are still required and efforts are underway to standardize the solutions, that is the CBS, the core banking solutions, and have robust set of internal controls implemented in the CBS for improved outcomes. The CAMELS, that is the capital, asset quality, management, earning, liquidity, and systems and control, that is the CAMEL supervisory rating methodology for UCBs, has also been comprehensively revised. We have also taken steps to bring UCBs under the acrylic reporting framework and issue draft guidelines on exposure norms to mitigate credit concentration risk and enhance and for enhancement in priority sector lending. To improve governance, we have issued guidelines on constitution of board of management for UCBs with deposit size of 1,000 crores and above. So a number of measures have been taken with regard to the banks, the non-banks, and the cooperative sector. So therefore, essentially, when we are talking of a banking sector for the 21st century, regulation has to be robust, supervision has to be robust, and essentially, the idea is not to stifle, not to create unnecessary impediments in the flexibility of operations of the banks. The focus is to sort of have proper supervision, and the focus is to enable the banks and to facilitate a kind of an operating environment, ecosystem where the banks have the necessary flexibility and the banks can sort of adopt innovations in business practices, can imbibe new technology, and the banks can really grow in terms of size to meet the requirements of a growing economy like India. So while the focus is on having robust regulation and supervision, the underlying theme is to facilitate the banks to become, to give the necessary flexibility to the banks and to enable the banks to sort of, to proactively improve their own functioning and improve their own performance on various parameters. Now, while focusing on all this, now, the banks, as you know, that they have a lot of interface today with the digital players, and the lot of interconnectedness between the banks and the digital sector has also become today very important. Now, you have in a situation in certain countries where digital methods of payment or digital banking is probably happening as a parallel process. But in India, it's very good to notice that the banks have recognized the usefulness of imbibing technology and collaborating with the fintech companies and adopting fintech, big tech, and similar other technology to improve their own lending norms and to improve their own, to improve their own reach of lending. So RBI regulation and supervision is also focused on providing adequate and appropriate regulatory framework for the digital sector players. Now, the key theme in, again, one more key aspect which the RBI, as the central bank, we are focusing is with regard to governance. Now, the issue of governance in both public and private sector banks, I think, is today of utmost importance. Today, when we analyze the performance of financial sector players, particularly bank or a non-bank finance company, when you analyze their performance over the last few years, I think what differentiates a well-performing bank or a well-performing NBFC on one side and a not so well-performing bank or a not so well-performing NBFC on the other side is essentially governance. I think governance is the critical thing that differentiates a good NBFC or a good well-performing bank from a bank which is not so well-performing. So therefore, a lot of focus has to be on governance, and on this, it is not just RBI, but I think it is essentially the management of banks have the critical role to play. RBI can only lay down certain rules and certain guidelines and certain, signposts, but ultimately the bigger responsibility as the custodian of depositors' money, as the, having an accountability to both the depositors as well as the shareholders and also to the wider public. I think the banks will have to necessarily focus on improving their governance, improving their compliance culture within their own organizations. As we have already said in our annual report this year, the RBI's annual report, which we released in, I think, August. And then as we have again reiterated in the trends and progress of banking in India, which was released on December 24th, as we have already stated therein, we would be very shortly issuing draft guidelines on for governance in with regard to the public and private sector banks. We will be issuing them very shortly, and it will be a draft guideline where we would be requesting, we would be expecting comments and observations from key stakeholders so that we can fine-tune our final fine-tune and then issue the final guidelines. So far as the RBI is concerned, therefore, these are broadly the areas where, as the central bank, we are focusing to ensure that we have an ecosystem for facilitating the for facilitating growth in the country, for facilitating, the sort of hastening the process of attaining a 5 trillion size so far as the economy is concerned, and also to make our financial system and the banks ready for the 21st, not just ready, but to play their, role in the 21st century and face the challenges that lie ahead. Let me now turn to the banks. I mean, with regard to the banks, I think the usual point I have mentioned about governance, but I think the most critical challenge today for banks, not just in India, but also elsewhere, it's seen, it's seen in all advanced economies like, for example, the Eurozone also, that I think the critical challenge they face today is slowing credit offtake. And slowing credit offtake, which affects profitability of the banks, and also the slowing credit offtake in the context of structural weaknesses of the entire credit flow, which is today happening. When I say structural weaknesses, what I mean is the over-dependence on government securities. And this is very, this is noticeable very much in the Euro area today, where a lot of bank funds deployment is in government securities, which earns naturally certain return for the banks. And the credit flow to the real sector, I think, needs to improve. So similar challenges are faced today by all the countries, and in India, as you know, the credit growth has moderated to about 7 to 7.5% this year so far, and the credit offtake needs to improve. Now, to facilitate the flow of credit, the Reserve Bank, as you know, that we have taken several steps, and I don't want to repeat the steps which we have taken. We have reduced the, as a part of our monetary policy, we have reduced the policy rates. We have also facilitated and provided for on-lending, provided for bank refinance to NBFCs for on-lending to priority sector. In the latest monetary policy also, we have announced several measures like the LTRO and then certain dispensations relating to the CRR. We have announced all that. But I think essentially the banks will have to focus on credit offtake and flow of credit. Now, while doing all that, the focus, of course, should be on doing prudent lending and and also maintain, to improve the operational efficiency of the banks. So there cannot be any compromise on prudent lending. There cannot be any compromise with regard to the quality of appraisal. I think the quality of appraisal is very, very important. And quality of appraisal will flow out of good governance. It will flow out of good internal control systems that the banks have. So therefore, the banks need to focus on, while focusing on enhancing their credit flow, enhancing their credit sanction and disbursement, due diligence, appraisal, and prudent lending have to be adhered to. And there has to be improvement in operational efficiency of the banks in terms of, today when you see that the bulk of the credit offtake today that is happening is with regard to individual loans or with regard to the retail loans. Wholesale loans in terms of project loans are not today as much. They're not recording as much growth as perhaps they should, but the focus has been on retail loans. And in retail loans, as you know, the growth has been this year about 16% or so, and within that, the housing sector growth is about 17 or 17.5%. That is the housing sector loans. So therefore, in this background, the slow growth of credit, I think that is the biggest challenge which the banks face. The second aspect is that in the context of a global economy which is facing a slowdown, and as you know, the IMF has also reduced its forecast for the world GDP growth now to as per the latest estimates, to 2.9%. And the impact of coronavirus, which is still playing out, and according to the latest statement from the IMF is analyzing the impact of the coronavirus on the global growth, which is already in a slowdown mode. So therefore, if global growth also, slows down further, it will again impact the health of the banks, because a slowing growth creates more stress, more stress in the corporate sector and creates more stress so far as the banks are concerned in terms of growing, number of stressed assets. Now, in this environment, what do banks do? So the banks, as I said, will have to continue to focus on prudent lending. Prudent lending doesn't mean that you stifle and stop sanctions of loans and other things, because you need to lend. Unless you lend, how do you improve your profitability? And you have any number of competitors who will overtake and will move ahead. So each bank has to therefore continue to lend. It has to continue to lend in a prudent manner. It has to focus at the same time on recoveries, and it has to offer low-cost products. Low-cost products can be offered by harnessing new technology. Low-cost products can be sort of offered by using the facilities which Reserve Bank has now offered in terms of the CRR low-cost products, meaning the low-cost, better transmitted, having a better transmission of the monetary policy decisions of the RBI and reduce the cost of loans. And therefore, it's very important for banks to focus on their operational efficiency. Now, so therefore, slow credit growth poses a challenge to the banks. At the same time, a slowing global growth, which gets further accentuated because of the latest coronavirus episode and its impact, which is still playing out. I think this poses a challenging environment to the banks, and the banks need to be really alert and need to be alert and need to prepare themselves to face these challenges. Because if there are challenges, then the response has to be that much more effective. So an effective response to a challenging situation is what is today key to the bank profitability, is key to the banks to continue to play their, is very key for each bank to maintain its competitiveness and to grow in size and to improve its profitability. I think on the question of the slowing down growth, as I have mentioned, that this could have an impact on the creation of stressed assets. So therefore, the banks will have to be very, very alert and will have to be constantly engaging with the major players in each sector. Each branch should be in a position to monitor the various loans which have been sanctioned, engage with the borrowers, engage with the corporates, engage with the MSMEs, and see how their business is operating and respond to emerging challenges. So I think the business of banking today has become all the more challenging, and rightly so, because we live in a world where new challenges emerge every day, where the banks will have to sort of play their role, as I mentioned. So when I'm talking of challenges, let me also for a moment not sound alarmist or not sound unduly pessimistic. There are challenges, I did say it and I repeat it once again, that there is no reason or no basis to feel sort of unduly pessimistic or unduly one should not allow oneself to be overtaken or or dominated by the new challenges which are emerging. What is critical is preparing an action plan, preparing a strategy to respond to the new challenges which are emerging. So therefore, that is, I think, very critical. And in this, the banks have to focus on two critical aspects. One is creating the required HR skills, the human resource skills. The focus has to be on training, on skilling and reskilling of their personnel, on improving the quality of the manpower in the banks. That is one area. Second is the banks should invest more. Both public and private sector banks and small banks also should invest more on technology, because how modern you are, how up-to-date you are with regard to technology is going to determine how competitive you are going to be. And so therefore, these are the two areas which they have to focus. And one aspect which I had also mentioned, that what could be a possible scenario in India with all these digital innovations coming in, the digital payment systems coming, the fintech, the big tech, the new business challenges which the banks are encountering. I think the possible scenario that I envisage, which is likely to happen, is that distinct segments of banking institutions may emerge in the coming years. The first segment may perhaps consist of large Indian banks with domestic and international presence. So there could be one segment of banks which are both in the public sector, thanks to the merger plan announced by the government, and in the private sector, where you have large banks, having both domestic and international presence. The second segment is likely to comprise several mid-sized banking institutions that would include niche banks with economy-wide presence. The third segment may encompass smaller private sector banks, small finance banks, regional rural banks, and cooperative banks, which may specifically cater to credit requirements of small borrowers in the unorganized sector and in rural and in local areas. The fourth segment may consist of digital players who may act either as service providers themselves directly to the customers, or they may act through the banks by becoming their agents or associates. The reoriented banking system will, of course, be characterized by a continuity and a continuum of banks playing a major role. The banking space would also include both traditional players with strong customer base and new technology-led players. So to sum up, the changing landscape of banking industry will unfold in the backdrop of a strong regulatory and supervisory regime with increased intensity and technology-enabled supervision of the banks. The challenge before banks is to make the best use of technology and innovation to bring down intermediation costs while protecting their bottom lines. Further, artificial intelligence, machine learning, and big data are becoming central to financial services innovation. They can also help in fraud detection and in identifying better ways of monitoring use of funds by borrowers, track suspicious transactions by processing large data sets. One of the challenges for policymakers, especially in countries like India, is to ensure that the new innovations in banking sector serve the customer by reducing the cost of financial services and enhancing the range and access to products in a manner that is safe. Advanced analytics and real-time monitoring of emerging cybersecurity risks will be critical in detecting potential threats and enabling preemptive action. As the Indian banking sector is propelled forward to a new and higher orbit, banks would have to strive hard to remain relevant in the changed economic environment by reworking their business strategies, designing products with customer in mind, and focusing on improving efficiency of their services and by imbibing new technology. The possibilities are enormous. We should be seized of the issues and act in time. Thank you.